So now let's look at how employee stock grants and employee stock options are different and how do they influence employee behaviors differently. We know that employees work to grow the company, and as they work more, the company grows more and more. In order to grow the company, employee puts more efforts. Now, how does employers reward employees? Company makes employees feel as owners by giving them part ownership in the company. Now, companies can do it in two ways. One is by giving employees stocks or shares, or by giving employees stock options. What are the stocks or shares of the company? Stocks or the shares of the company are part ownership of the company. In the watermelon, that is like giving a slice of the watermelon. What are the stock options? Stock options are a promise to give employees shares of the company tomorrow at today's prices. In the watermelon example, it means that if the watermelon grows from its current size, the employee will get a slice of a part of the watermelon growth. But if the watermelon stays the same or shrinks, then employee gets nothing. The growth is nil and employee is not getting anything. So in options, employee get a part of the watermelon only if they make it bigger. In the financial term, stock options are options to buy stocks of the company at current prices in future. This price is called the grant price, which is the today's price, and you will get in the future also the same price for the company. Now let's look at stock grants and stock options at a glance. Stock grants are simply stocks or shares of the company. Options are option to buy stock at current prices. In case of stock grants, employees' fortune go up and down with the stock price because it is the stock that they are holding. In case of stock options, employees gain only when the stock price grows higher than the current price. The price goes below the current price, employee gets nothing. Let's understand more the risk and reward of stock versus options. If you have $10, then you can go in the market and buy stocks. Options are typically cheaper than stocks because these are not stocks, these are options to buy stocks. As an example, we can say if you have $100, you can buy 10 stocks or you can buy 30 options. In the market, we typically see that option price is less than the stock price. In a stable market, for a typical stock, option price is 1/3 of the share price. Now what happens when the stock appreciates? When the stock appreciates, the gain from the stock is like as much as the appreciation in the stock, but from the gain of the option is much more than that because you bought more options than the shares, so obviously you gain more when the share price grows. Now gain from the stock was 10%, while for the gain from the options is more than 10%, let's say even up to 30%. Now what happens when the stock price goes down 10% from the grant price? You suffer a loss. If you have the stock, the loss is 10%. Since option below the current price does not mean anything, so there is no value in options if the price goes below the grant price and it is worth zilch. So now back to our summary of options and grants. The shares are low risk and low return, and options are high risk and high return.